Yeah, and if that thing wasn't as creepy as that is, then it would be even better. But that doesn't help. So anyway, just for I guess even just personal documenting purpose of this call, as we kind of talked about, was to go through some underwriting and analysis methods of, I would say, smaller or mid-sized multifamily properties under, let's say, 50 units, of how to actually analyze them, and then maybe any neighborhood stuff used to review them. So looking at a specific deal, but I think what I sent over was just like high level last night.
Yeah, so you sent over, looks like a portfolio of 2 properties. One was a 20 unit, one was a 16 unit. Is that the broad shapes? Yeah. So these were in, the first thing I noticed is what town they were in. So they're in Middletown, Ohio, right? Yeah. So what I tend to do, if I get something from an area that I'm not familiar with, is just to get a sense of what type of market is this, right? Is it high growth? Is it kind of middling along at like a national average, not usually above, not usually below? Is it kind of stagnant, or is it dying, right? And because if you get a 9 cap, you might think that's great, but if it's in a dying market, you can't fight the tide, right? The tide is eventually going to go out or in on you, whatever you want the metaphor to be, and you're powerless against it, right? So know what kind of market you're into. And it's not to say that any deal in a dying market is a bad one. You just need to know what you're going up against and if that risk is worth what you're paying for it and for your personal goals. So for Middletown, Ohio, can I share my screen?
Yes, that'd be great.
All right, I'm gonna go ahead and just capture my browser.
And it's funny, Ryan, you said that, because this morning my brother and I had a call with someone in territory based in Cincinnati, and it was the exact same thing. So I'm curious, like when we get into it, because he said, yeah, like in some areas where they're either flatlining or declining, like his rules, like I'm not looking at anything under like an 11 cap. It's like a 9 might sound great, but if it's flat or declining, like that just doesn't fit my build. So I'm not saying that's my criteria or even yours, but it was just funny because it sounds like that might be where we end up with this. But take us home.
And it gives some framing too. If we pencil out a deal and it's like, wow, this deal looks great, well, we'll know why if it's in a dying market. It's like, oh, okay, this is what I'm buying into. So cash on cash looks great, but it's because 5 years from now, you might your rents might be down 20% or your occupancies or something else. The easiest thing I do is I just do a Google search for, and it always brings me back to this worldpopulationreview.com site. But I'll just do a search for, what's it called, Middletown, Ohio population growth.
Yep.
It takes me to worldpopulationreview.com, and I'll just scroll down to this graph and the chart they have here. Sorry, this is an ad-laden site, so if you can tolerate that for just a couple seconds. So, here's a graph of population, and the census used to be every 10 years, and now they do projections every 1 year. So you get better granularity on a year-by-year basis more recently. But you can see, ever since, call it 2000, it's been in decline and pretty stagnant. And if you go down to the chart here, you see a lot of negative percents or very low percentages. Just for reference, the national average is 0.6% as far as your annual growth rate. So anything below 0.6%, even if it's green, is kind of just below the national average. It's like a good metric to be aware of. So we see for basically the last 20 years, this is not a town that's doing well. So it's like, all right, I mean, that is what it is, but at least we know. Just for comparison's sake, let's look at Columbus, which is a favorite of mine. Misspelled growth, Google will fix that. World population review for Columbus. Obviously it's a bigger metro, but even on a percent base, like look at this. Look at this green that goes back for decades. In the last decade, everything above 1.5%. Where's the graph of that? Oh, looks like the graph didn't come up. Yeah, there it is.
Wow,
I mean, look at that. Like that thing is just taken off. So there are areas of Ohio that are doing well, Columbus and maybe a few other ones. I know Cincinnati and Cleveland are actually the opposite of this. And Middletown kind of seems like it falls into that camp of kind of stagnant and negative compared to the national average. So it's like, all right, I mean, again, that's not a deal breaker, but now I know what kind of market this is. And we can use that to frame the rest of the analysis. So that's
And
kind of
just one
step one for
question
me. If
on
it's an area I don't know. Yeah.
that's okay. So that's just like a good quick snapshot. It's good to see that. So like when you see a population that's declining or even flat, are you looking at that as a negative more so because you don't think there's maybe a secondary, like a resale market in 5 years or so, or you think that it's more you'll have trouble having demand for tenants to fill your space, or a mixture of both?
You know, you can dig into deeper levels of analysis, but it's good to have kind of like your golden metric. And for me, population growth tells you a lot about a lot of different things, right? So if it's a strong economic area with good jobs and diverse economy, people are going to want to live there. If it's generally affordable, people are going to want to live there, right? All things lead back to population growth. So when we think about it for small multifamily, you know, it's not necessarily about resale for me, but that's an auxiliary concern. At the end of the day, if people don't want to live in that area, you can't have rent growth, you can't have good high occupancies, you don't have pricing power, everything else. So, and if you don't have those things, then yes, it will be harder to resell. And yes, there may not be another seller, but that's the second order effect of the core issue itself, which is that lack of renter demand. So that's what I really
Got it.
think population growth is the best indicator of.
Mm-hmm. Okay, makes sense.
Cool. So that's like the market. And again, if I'm already familiar with a market, like if it's a Raleigh Durham around here or Charlotte, or even a small town that's kind of in an area, there's areas of North Carolina where I'm in that, even though North Carolina in general is a good business climate and strong economy and has positive net migration, they're still dying towns and kind of stagnant towns in North Carolina. So I just happen to be aware of them for the most part. But Middleton is it Middleton or Middletown? How do they pronounce it up there?
I actually was told this morning Middletown, but it's because it's dead in the middle of Dayton and Cincinnati, I think. So it could be for both.
So it's literally Middletown, middle
Yeah,
of the road. Okay.
they got
Yeah.
creative there. Yeah.
Cool. All right. So what I use for analysis is Michael Blanc's SDA, the Syndicated Deal Analyzer.
Mm-hmm.
All these modeling spreadsheets basically get you to the same point at the end of the day. It's really about your comfort with them. Do you feel like you can navigate them? Are you quickly? Are there other, if you're interacting with other investors, are they likely to know how to quickly navigate that? And I find that Michael Blanc's SDA is pretty well understood and pretty popular. So as a general ecosystem,
Mm-hmm.
I find that it's good to kind of use this tool. And I've tweaked this one a little bit, but more just out of convenience. It's pretty much what you get when you buy it from Michael Blanc.
Mm-hmm.
So let's look at the information you sent over. You sent me an email that had some basics, and let me share that. Where's that email? Here we go. Okay.
Yep.
Can you see this? All right. So this is pretty common when you're dealing with smaller units, smaller buildings, smaller sellers. This isn't formally marketed. It looks like it's kind of off market, right? So you don't get an offering memorandum, which is this nice little pretty package that has a bunch of pictures and tells you what your pro forma should be. It's like in an email, you're getting a back of the napkin. This is kind of what things have looked like. Ideally, you'd love to get a T12, which is your trailing 12 months of financials. You'd love to see the rent roll, like line by line, unit one, that's a 1-bedroom, 1-bath rented for $650 and whatnot. So there's a lot of red flags or a lot of detail that you can get by looking line by line by that. But if we're just kind of trying to get sense of, okay, what's this offered at? What are its expenses? What's it's renting for? This is good enough. So I'm not going to do both of these. It looks like these two tables reference both a 20 unit and then a 16 unit.
Yeah.
So let's just do this 20 unit. So we got our purchase price here. It's $865. I need to switch back and forth between my spreadsheet and the email, but you can only
share your. You should be able to. I can see what you're looking at now. Actually, I could see the email, and
Yep.
I was able to see the spreadsheet. So I don't know if you had it shared that your whole monitor was shared or just the.
Yeah, I was only doing it screen by screen, so I have a bunch of other crap on my screen, but I can shut all that stuff
all good.
down. I also have a really big
All,
monitor. I never know, if I'm trying to share my massive monitor, if stuff gets kind of washed out. So let me see here. We'll shut some stuff down.
all good.
All the crazy stuff I'm into. All the incriminating. All right. Let me just share my whole screen. Okay. Can you see my whole screen now?
Yes. Perfect.
All right. So let's move some things around. Okay. So
Yep.
left side, I've got your email, and we're just going to focus here on this top table. And then on the right side is this SDA that's loaded in Google Sheets. So what I'll usually go through is I'll just drop in the asking price. And this is like the first pass analysis that I do. So we kind of talked about how deep you go at this stage, which tool do you use? I still use this tool, but I just enter a few key numbers, do some quick calculations just to see where we're at as a first pass. So that's all we need to kind of look at today. This is a 20 unit. Let's see, does it tell you? Okay, here we go. Down here, 8 units are 1 bed. Looks like 16 1 beds and 4 2 beds.
Yep.
Right. So I'll come over to my spreadsheet. We have 16 1 units. 16 1 bed, 4 2 beds for 20 total. I'm going to look at what the average rent is. I'm going to ignore full market for now. So it looks like 3,495 on that building, 3,440 on that buildings are your 1 bedroom. So let's add those together. 3,495 plus 3,440. And we're going to divide that by 16 and then divide that by 12. So 16 units over the full year. So 16 1-bed units over the full year. Oh, what did your math teacher, your grade school math teacher teach you about parentheses and order of operations?
I'm done.
Yeah. All right. So actually this email, the rents it's showing you is for the month, not for the year. Okay. So those rents divided by 16 equals $433 in average monthly rent for the 1 bedrooms. So I'm going to come over here in my spreadsheet. I'm going to enter 433. I'm trying to enter the actuals right now. I want to just, without thinking about what great things I can do to the property, I'm going to put in the actuals and just see where things pencil out. So let's get the average rent for for the 2 beds. Looks like there's 4 units here. Total rent of $2,245. So $2,245 divided by 4 is $561 average rents. So 561 over in my spreadsheet. I just filled in these numbers right here. We're following along.
Yep.
Okay. So across the 20 units, the average rent is $459. Okay. So that's the income side. Now I look at the expenses, and it looks like how they delivered it to us was just these line items. These looks like the monthly expenses for the most part. They've kind of mixed in annual numbers here, like annual NOI, with monthly numbers. So again, this is just back of the napkin. Somebody's sliding you a piece of paper under the door, right? It's nothing formally put together, but we can still work with this. What I like to do here, I don't like to get into the line item. I just sum up all the expenses and I'll annualize them and see what the expense ratio is and enter that to my spreadsheet instead of having to go line by line here. You see where expenses are right here in my spreadsheet?
Yeah.
Too much level of detail right now. So let's just add up all the fees that they say they have. Usually they're going to understate them. And so we can talk about any red flags to know if these are realistic expenses or not. So 760, they have vacancy listed there. I'm going to ignore that for now. 760 plus 475 in maintenance, plus 300 a month in insurance, plus 956 in insurance, in taxes, plus 1417 in like contract services, lawn, et cetera. Total expenses, by my calculation, excluding vacancy, is 3,908. And if we times that, we want to annualize that because the spreadsheet analysis uses annualized numbers. So that looks like it's 46,000 something. We'll call it 47,000 is my total expenses. So I'll go down here and I'll just kind of, I'm going to manually enter 47,000 for my total expenses. So let's talk about vacancy. So we know with an average rent of $459 a unit over the course of a year for 20 units, if you were 100% occupied all the time, you could get about $110,000 in rental income. This is also where kind of knowing your submarket comes into play. In a really strong market, you've seen vacancies of 3-4%, quite low. Maybe a national average is close to 5 or 6, but we're at historical lows when it comes to vacancy. So this is actuals. So usually what I'll do here is if you have the full trailing 12, you can play with the vacancy and concessions number to get to what the actual collected rent for that year was. We don't have this here, right. But for a property like this in a market like this, I'm going to say total vacancies, anywhere between 8 and 12%, depending on how conservative you want to be. If you want to give the seller a little credit, you can maybe just do like 10% total. So
in this case, I'm just curious how you would still underwrite this. I did see this property and they don't have any vacancies currently. Do you factor that in, or do you still just go conservatively 8 to 12?
No, I mean, anybody can have no vacancies at one point in time, right? And very few people actually track their historical vacancies. It's just like, hey, I ran the rent roll today and we're 100% occupied. It's like, well, good for you, right? You got everybody under market. You got crappy tenants in there because you want to sell. It's really much more about the market and having seen the property and maybe the type of tenants that they have, kind of taking that into account.
And can you just talk to, I guess, physical vacancy versus economic vacancy for those that may not know what that means or how you think about it, if you do think about it?
I tend to think of total vacancy. So I'll define both and then I'll kind of talk about how I think about it. Physical vacancy is, do I have a tenant in the unit or not? That's the most easily understood concept, right? It's very visceral and it's black or white, right? Either they're there or not. Economic is great. You've got somebody in your unit, but they haven't paid, or it's bad debt, so they haven't paid for a while, and you're gonna have to write off that debt, or they're way behind on their rents, and all the reasons why somebody might be living there, but you're not getting money for that service that you're providing. And it's not always bad things. Like sometimes it's concessions, right? So you run a special which is half month's rent off your first month. That whatever your rent divided by 2 is a concession that you've made to attract somebody to come in. But that's an economic vacancy because you're expecting that unit could rent at this. You've decided to cut it in half for that small period of time. So that's a concession. That's an economic vacancy. So all those things kind of factor in. And I think about physical and economic vacancies as two sides of the same coin. Like they're levers that if you move one, you can move one up or down to change the number in the other. So I like to think more about total vacancies. So you can run a bunch of move-in specials. It's going to increase your loss to lease and your concessions. So your economic vacancies go up, but you get more people in quicker. So your physical vacancies go down. Right. So there's a very tight correlation between the two. And as a landlord, you can kind of tweak the levers to find whatever the right balance is for you. So that's kind of the summary on vacancies.
Cool.
Yeah.
Makes sense.
All right. So where we're at now is we have a general sense of how much income this property generates. It's almost $100K a year. We have a sense of what they said their expenses were, which were $47,000 a year. At this point, I like to look and see what the expense ratio is. which is
Ryan, one
just,
thing, are
yep.
you done with the email sheet? Just because if you are, it's a little the font's a little small on the Google sheet. So if you're
Okay.
done with the email, if you could maybe just go full page with it.
Yep. I can also bump the font.
Yeah, that would help.
There we go.
Maybe you can do one more.
What are you, 75? Yeah. Is that good?
Millennial millionaires, man.
I
All right,
know.
yeah, perfect.
Cool. Yep. Okay. So I like to look at the expense ratio just as like my first check-in of how realistic are the numbers that the seller's giving me. 47,000 divided by 99,000 is a 47% expense ratio. That's probably about right. Anything near 50, is pretty good. In these smaller multifamily, so again, 12 to 30-ish range, you can get with good management kind of in the low 40s. I've seen as low as high 30, like 38% expense ratio. I would never underwrite to 38 expense ratio. If I felt really confident about the type of property, the market, et cetera, I would go maybe mid 40s if I could really justify it once I kind of go line by line. So to get from the seller that the expenses are around 50%, it's like, okay, that feels pretty realistic to me. And I would certainly hope when I get in and start managing it to my standards, I could even get that a little lower in the 44% range. Sometimes you'll see 60% expense ratio. You definitely want to understand why it's that high. Could be an opportunity, right, for you to come in with professional management and do a better job, but it could also be there's something really wrong with the market, the property, whatever. You really want to understand when it gets that high. I would say anything over the low 50s, definitely dig in and understand why the expenses have been that high compared to the income. But this one checks out. So with that little bit of input, I've just done average rents, and I've done some basic vacancies, and I've done expenses. You kind of have enough to start getting a sense of where you are compared to the seller's list price.
Just the one question on that, and again, for anyone that's maybe checking this out as far as getting into underwriting, understanding financials of a property, that number, and maybe if you could just do a high-level explanation of why or if not, that number doesn't include the mortgage, correct?
That's right. This is operating expenses. So you take your collected rent, you subtract your operating expenses, which are all the non-levered expenses. So anything that's not related to financing, and that gives you your NOI, your net operating income. So things like capital expenditures, like if you make investments into the property, like buy all new HVACs or new carpeting or things like that, that doesn't go in repairs and maintenance, right? Repairs and maintenance are things that have no long-term value that you're just having to fix. But CapEx financing goes below the NOI line. Okay, so a lot of the valuation in commercial real estate is done based on the net operating income. And since every buyer has different financing and debt obligations and needs, that's really the only clean way to value a property without having taken the variability of everybody's different financing situation. So we see this property has $52,000 in net operating income. And down here, cap rates are a thing that you should definitely be aware of. They're not an end-all be-all, but they're a really good kind of measuring stick for a property's value compared to its risk. So a property with an NOI of $52,000 a year that has a asking price or purchase price of $865,000 is around a 6. Well, here it is, the cap rate. It's a 6% cap rate. Okay, so you hear that. That's a 6 cap. So this is your first kind of evaluation point. It's like, okay, this is a small multifamily. It's to be generous, it's not in a dynamic growing market. I think it's C class. I don't know, would you call it a C class, B class asset? How would you rate the quality, the caliber?
B minus.
Okay.
For Middletown, not for, I would say, the broad multifamily space, but for Middletown, there's a Starbucks down the block, there's a Dunkin' Donuts down the block, a Walmart down the block, and the condition was pretty good. But again, that's all relative to Middletown instead of comparing it to Columbus.
Yeah, I would. That's fair. I would definitely, my initial take would have definitely been C class, looking at what the average monthly rents are. $430 for a one bedroom, seems quite low, but it's in that type of market. So if it's well taken care of, if the tenants are working class, but by and large, not hugely problematic, the area is okay. Sounds like, it's got a Walmart where you get all your clothes, so it sounds like it's a good area. Then maybe a 6, then maybe it is a B- class. So a 6 cap for small multifamily in Middletown feels like the ask is pretty high, right? For the income that this property is currently generating, paying 6% cap rate feels like you're paying a lot. Okay, so that's my first take. Now, that can be fine if there's a lot of upside here, right? If you buy something at a 6 cap, but you can push rents $100, $200 without much work, then there's opportunity that you have to take advantage of. So now this goes back to what you know about the property. So tell me, is this pretty much operating as well as it can? What's the rental upside opportunity that exists with a property like this?
Yeah, so great points. And this is exactly what I think I was hoping we'd get into, because the tenant base in this property has been in there for I want to say an average of 8 years, and they haven't really pushed rents at all. They have done a lot of exterior repairs, like roof, stuff like that, water heater, boilers. But the rents are very low compared to what a couple local property managers said. And if you just run them both on Rentometer, the one bedroom average on Rentometer is 600, and I'll pull up the 2-bedroom average. But so the 1-bedroom average in the area is 600, and the 2-bedroom average is 717. So off the bat, it seemed like there were easy value add opportunities. And then I did brief those and vet those with 2 local property managers and then a realtor that we have in the area. So that was what stood out to me, just because it seemed like the rents currently were incredibly low.
Okay. So will it take any investment, any capital investment, rehab to get to that 600? Or does your property manager think, nope, I can take this unit that's currently occupied, I can charge 600 with no investment and we're good?
So those, I would say, even though those are the averages, they would still probably be higher than I'd conservatively like to think. So what I was told is that in this area, someone that had familiarity with this property said, if you just put new paint and carpet and maybe turn the appliances, or maybe just spruced up just the kitchen area for 500 to 1,000, maybe just repaint the cabinets or something like that, then you could get that average.
Okay. So it sounds like a light turn on these will get you that market rent of 600 and 715. So what I'll do is I'll go here in my repairs and reserves line. And now I'm operating in this column, the offer column, right? So I've entered the actuals, that's in the marketing package. And then I just skip over to this column. I pretty much do all my work in the first column for actuals and the last column for what I think the potential of this property is. So repairs and reserves, my just lowest I'll ever go when I buy a property is I want to know I've got $1,000 for every unit just sitting there for CapEx reserves, and for the next time that unit turns, if the whole place goes vacant the day I buy it, that I know I'll probably at least have $1,000 per unit that I need to invest to get it ready for the next person, outside of true investment, just turn costs. So I want to know I have that money sitting there. So we look at this formula, it's this cell, which is the total number of units, times $1,000. So it sounds like, and I kind of have, when we're talking now about investment, the different calibers of investments, I kind of have some per unit default costs in my head. It sounds like what you're trying to do flooring, paint, maybe some cosmetic stuff. You talk about appliances, which is a little above extra. But if it were just the most minimal turn you could do, maybe have to clean or replace carpet, maybe have to paint and just do some cosmetic stuff here and there, I'll kind of put that at 2,500. You sound like you maybe want to throw a little extra in the kitchen, maybe do an appliance. I'd probably set it at 3,000 per unit as the cost to invest to get it able to reach that market rent. So I'll usually just say, okay, I want to know that I'm coming to this deal with enough cash to be able to invest into all these units. So it's the number of units, 20 times $3,000. My average interior rehab is about $60K in repairs and reserves that I want to come to the deal with. And with that $60K, I think I'll be able to get this target rent. Okay. So now in this column is my assumptions, not what the seller has told me, but it's my assumptions. Vacancies, knowing what little I do about Middletown, 8 and 2 is probably a good long-term kind of baseline. With COVID, that's definitely changed in my mind in the short term, especially economic vacancies, right? So people still are going to be living somewhere. It's just going to be a lot harder to get money out of them. So I'm going to skip over that detail for right now. That goes a little deeper into the P&L tab, which we probably won't cover right now because we're just talking about what does that surface level analysis look like to know if it's worth going and putting in more effort. So I'm just going to leave it where we are. But we see, just at a first glance, we think we can take a property that's earning 100K in net income, not net operating income, but just top line net income, and we can almost add 35K of income. Like, all right, that's a 35% increase with about a $60,000 investment. So that feels pretty good. Like feels like there's enough meat there that you're doing. There's some value add to be there, some forced appreciation. I'll come down here to my expense ratio.
Yep. Are there any like rules of thumb you like to see as far as calculating the cost of a value add versus the return, or a period of years that you like to see that amount be repaid in? Any like rules of thumb or advice on that?
Well, to your point about returns, value add is more risky than already stabilized, right? There's just more variables. There's contracting work that has to be done. There's longer periods of downtime. There's more liquidity that's required. It's just more unknowns, which equals greater risk. So as an investor, you should, if it is a value add, there's forced appreciation potential. That's good. But you should expect to receive a greater return on your investment for that risk. Okay. So, if this is a value add property and it pencils out to be a 5% annualized return, that's not enough return to justify your risk for what my goals are, right? So you got a second part to your question though, outside of the return itself. Something around the timelines?
The timeline, or like time of repayment, or like in this case, it would be like maybe a 35% increase in revenue, but I guess understanding the ratio of the increase in revenue versus the ratio of the cost to actually do those repairs, to implement that value add. So like that 33,000 or 2,500 per unit expense compared to then now that 35,000 K addition to the NOI. So like just a ratio to kind of balance the two.
Let's talk about that when we get to our net operating income, because the delta in NOI, when combined with the cap rate, is going to tell you how much juice you're getting for that squeeze. So
perfect.
We know we've got 35K in increased top line, but our management fee, which is percent based, will increase as well. So a lot of these expenses are proportionate to the amount of collected rent. So your expenses will go up a little bit. Again, I'm going to assume you've got a qualified, competent property manager. So I'll set the total expense ratio at 45. I think you can go lower, but we don't want to squeeze this thing so tight that there's no buffer. So 45, maybe 43, if I really know the area and have a great property manager, is kind of what I would underwrite. So now let's look at that NOI line. We've taken the net operating income from 52K to 74K. So that's 22K in increased NOI. cap rate, let's assume that a realistic cap rate for an asset like this in a town like this, call it 8%. Here's a calculation that you can do to determine what increase in value does this increase in NOI result in as far as like a purchase or a sale price. So 22,000 in increased NOI divided by 8%, my cap rate. That equals 275K. Okay. So if properties like this in Middletown are trading around an 8 cap, if you can increase the NOI by 22K, you're increasing the value of that property to 275K. So it took you a 60K investment to get that increase in NOI, but your return on that investment was 275K, right? So you've got a 4 times ROI on what you put in to a property like this if you're able to achieve those rents. Cool.
That's kind of what I was getting at before. So that's exactly it. As far as like, I think a lot of times people get stuck on, well, I think this repair will yield this much in return, or maybe I'm not sure how much it will, but I'm not sure if I should do it because, I'm not sure if putting that 60K down is worth whatever juice I'm going to squeeze out of it. But in this case, again, perfect world, we're living in a spreadsheet right now, not in the property, but if it did work that way in your mind, then it would be a very good way to add value to increase the property value.
And to your point about kind of trying to find the ratio or a quick shorthand to know if I invest $1 in this property in this way, what it will equal, what's the ROI in that. $1, every $1 invested, anytime you can increase the rent on a unit by $1 per month, I believe by my shorthand, it equals $150 in added value to the property, right? So let's do that math, and we'll use 100. So if I can add $100 per rent, no, let's keep it at 1. So if I increase rent by $1 on 1 unit per month times 12 months, divided by an 8 cap is 150. So if I can do something that can raise rents by $10 a month, shorthand in my mind, 10 times 150 is 1,500. If whatever I'm investing to get that $10 increase in rent, maybe it costs $250. I'm like, okay, $250 is the cost. My shorthand times 150 for that $10 is 1,500 in return. That's an easy win. So 150 is the multiplier in my head for every dollar in rent per month that you can add is what the added value is to the asset itself.
Got it. Cool. Really good.
Cool. All right. So we've got enough to know, hey, should I dig into this more? Let's look at our financing assumptions real quick because we are in kind of interesting times regarding financing. The down payment was at 20%. You're probably not going to be able to get a loan, especially for a small multifamily like this, for anything less than 25%, maybe even 30. So I'm going to put 25%.
This is a little bit more of an interesting scenario. The seller, and we could factor it in if it's some of this I know it was confirmed. He's willing to do seller financing for 20% down. Okay,
great. So let's do 20% down. Has he given you any indication of an interest rate or what his priorities are?
Interest rate, we're negotiating, or just early stages of back and forth. He said 30-year AM term. Interest rate somewhere between 5 and 6.
Okay, call it 5.5. Yep. So, okay, now that we have that in place, I'm going to just take a quick look at the total capital needed to close. So this is closing costs plus your down payment, plus your reserves, legal fees, all that stuff. This is the cash that you need to have on hand to be able to execute this deal. It's around $265,000.
One other question, would you adjust that at all in an owner finance operation without maybe as high closing costs, or still keep it high, and then if you need less, you need less?
that's definitely going to go down. So there's a whole nother tab that covers acquisition costs. I'm just going to skip over that, but I will estimated closing costs right now look like to be around 3% total. Just because you don't have a bank that's requiring you to get an appraisal, get a phase 1 environmental, do this, do that, doesn't mean you don't want to do those things, right?
Right.
So it's not like all those costs go away, and your seller may still require points, may still require that you pay his lender fees to establish the note and things like that. So you don't want to slice your closing costs way down to nothing until you truly know what you have. But maybe you want to drop them to 25,000 instead of the kind of the 3% estimate that we had.
Okay.
Yeah. So still, it's around 250K investment. So it's like, okay, 250K, do I have that? Can I raise that? That's like one check-in point. Then the other is just some metrics down here. Again, this column, the offer column, is kind of my stabilized potential. Now with COVID and other factors, it might take me 2 or 3 years to get there. So in the P&L section is where I kind of factor in, okay, how long is it going to take to get to that point? But as a first pass, I want to know that once I am stabilized, does this deal, is it even offering anything of note? And so I'll look at some metrics here. Looks like the cash on cash return, I think this is the average, maybe is around 10%. It's a pretty strong cash on cash return. Your debt coverage is going to be 1.5, right? So most lenders, and I know you're using seller financing or hope to, but even still, it's a good metric to know how levered you are. So this is saying that you are bringing in 50% more income than you need to pay off the debt. Okay. So it's basically the lender's way of saying, how sure can I be that I'm going to get paid, right? And most lenders look at a DCR of about 1.25. Now we're seeing it creep up because we're in a higher risk period of about 1.3, right? So anything that's 1.35 and above is a pretty good buffer between what your debt, what you're going to have to pay for your mortgage, and what you're bringing in. There's enough meat there that even if things get kind of squirrely, that you're not going to have to go back to your lender and be like, sorry, I can't pay, right? So those two numbers look pretty good. So, at first pass, even at the full ask, it looks like you could get it to be a pretty good cash flowing asset. Now, cash flow is not the same as total return. It's not the same as investor return, right? Investors bring money in, but when there's an investor, it usually means you are now expecting some like general partnership slice or a manager slice of the deal, which cuts into your investment returns, right? Because you have money that's working, but then you're expecting return, but you're not bringing any money to the table commensurate with that. So it starts to whittle away at your returns. So that really depends on your investment approach and goals to go to the next level. But if you're comfortable with Middletown as a market and know the risks and whatnot, and just want something that looks like it might be a decent cash flow opportunity for the next couple of years, then it might be worth going one step deeper on this one.
Got it. And you mentioned it earlier, and we talked about this before the call, that in some cases there can be just like a first pass metric or first pass analysis that a deal comes in, a broker emails you, or you find a deal. Let's say the phone rings, either way, however it comes, and you just want to do a quick analysis to see, is this something worth pursuing more? Is this something maybe worth going out and seeing? Is this something maybe worth going out and offering on, to then get to that next level of due diligence to understand the inner workings of the property and then speak to the property managers in the area, whatever. So it sounds like, and we did this in a more drawn out way. This is we're coming up on about 50 minutes, but this to me seems just like a great way to kind of test the market, test the property, just to run it quickly. And then you can obviously, looks like there's 20 other tabs here, 10 other tabs here at least, that you can then go through and then analyze, okay, here's more detail once I know it, instead of just a very quick snapshot that a broker sends me in an email with just some budgeted line items. Is that kind of how you do it when you just want to do something quickly?
There are people I know that use there's a quick equation that you can use, excuse me, where you the um, take the annual income, you times it by 0.9, so it's 10% vacancy. Then you divide by 2, 50% expenses, that's your NOI. Then you divide your NOI by whatever the cap rate is for the area. That's like the brain dead simple way to do it. Just to even know if you're close. So I've done that before, but in general, there's so many different nuances, and each one of these cells, not each one, but there are certainly some cells in here that are very high leverage. So, if you got 100 units and you change an average rent from 435 to 450, that actually, at that type of scale, will really result in a meaningful change to some of your downstream numbers. So I've gotten comfortable enough with this tool, and it might be intimidating at first glance. Once you get comfortable with it, you're in here 5 minutes and you've got a much better sense of how close this property is to being something viable. So I tend to avoid the whatever times 0.9 divided by 2 divided by my cap rate. But that is something you could do if you really understand the cap rate and in a certain area.
Yeah, makes sense. And then, there's this, I would say the one I use is similar to this, but I like how it just very quickly, it seems like the middle two columns you can play around with, but you're in column C and column L to pretty much get an idea of current versus what you'd offer on or what you'd expect or hope. And yeah, then just kind of compare. This seems to me a good mix, like a hybrid version of fairly simple, but also it has enough detail that you could probably, I'd say, get to that next level of interest based on this, and then even use it to figure out if you want to go forward on a property with an offer.
Yeah, once you decide to go in a little deeper, this is your starting point, and then you're going to come back to this and add more detail and refine it and dig in deeper on some of the other tabs as you get more color into the acquisition costs or exit strategies and things like that. So I just like to start in one place and end in one place and just refine my granularity over time.
Just real quick, do you mind just giving a high level on what the other tabs represent and when you would maybe jump into those? Don't have to go into any of them at all, but just high level.
Yep. Summary tab kind of spits out what the numbers I look for down here are kind of your investor returns. Again, with putting the minimal information up front, this is like the starting point for what your total return would be, your IRR, et cetera. It's got a lot of other detail, but it's a summary of what this investment looks like. P&L, hugely important.
This is pulling from the scenario tab.
Exactly. Yep. So there's very little in here that you go in and edit, or at least that I do. You can play with your investor splits, any preferences that you have as far as like the investor return pref, things like that. So it starts to get into the weeds of, as an investment, how do I want to slice and dice this? What levers do I want to move to get my investor return up, and things like that. P&L, once you enter stuff in the summary tab, I go directly here to truly understand what this property, how it will perform. Won't go too deep right now, but the P&L is the source of truth, right? Everything else is an input into the numbers that show up in your P&L on a year-by-year basis. Exit strategies are, how long am I going to hold this thing? Am I going to refinance, right? What are the capital events that can return back to my investors? Returns are just going on a year-by-year basis and showing you what your members, your limited partner investors get, what you as a manager will get, what the cash on cash return is, your total returns. When you sell it, how much we'll get back. So it kind of breaks down where your returns are coming from. Is it coming from the annual distributions, or is it coming from the capital event at a refinance or at sale? So it just goes into more detail there. And then acquisition costs, IRR, these other tabs just start to get into more of the details that show up on the summary tab, that kind of sum up to go on the summary tab. But for me, I've kind of rearranged the tabs. Scenario, summary, and P&L are are really where you are really the meat and potatoes of this. And like, you know, the P&L can, it shows a necessary level of detail before you decide to move on, like to really understand what you're dealing with. For instance, this deal looks like it carved out to be around a 10% cash on cash. Let's look at the returns to see how that was. So that's cash on cash return. Maybe that was average return was 10%. Okay, I'm getting sidetracked. So I have entered some kind of conservative numbers for year one because year one is COVID year, right? We're in 2020. So I take what I think my stabilized physical vacancy is going to be, and I increase it by 40%. So I times it by 1.4. And then excuse me, whoops, I'm messing up my cells. I quadruple what I think my stabilized economic vacancy is going to be. So I think that's where we'll really be hit. So I'm bringing my total vacancies to almost 20% in year one. Maybe that is wildly inaccurate and like it won't be that bad, but I want to know if I'm going to be transacting in the middle of the COVID crisis that I've got a buffer, right? And so I want to know that I can take the lumps that are given to me in year one, and this is what I'm comfortable with as an operator are those vacancies. If somebody's in a different market, a different area, has a different set of experiences and is not concerned to that level, or is in like an A-class property and a bunch of white collar workers are working remotely and their lives aren't really disrupted, you could have a very different number here. So it's not right or wrong, but this is kind of for the type of asset, small multifamily, C plus B minus that I operate in. It's kind of what I'm comfortable with. But we come down here and we see it's actually a negative cash flow in year one with these really high vacancies and with us not pushing rents yet. One of my assumptions is I'm not going to be able to raise rents in 2020 because of what's going on. So that's a lot of dings. No rent growth, high occupancies, expenses for the most part staying the same. That's a lot to have to overcome. So almost negative 20K in cash flow in year one. It's like, okay, well, do I have the capital to weather that? I'd rather know that up front and bring that to the table as part of the reserves, right? But when I close, than to be surprised by it. But you may not have the ability to go negative in any year. And so that might be a deal breaker for you. So the P&L really peels back the details of any one year, any one period of time, and shows you exactly what's happening with that property.
Yeah, this is really good. And this is I think you nailed it with some of the guesstimates or assumptions you're making for COVID. Even if you have people in there, economic vacancy is going to be very strong. But yeah, I think that would help a lot of people that are considering doing an investment and they're not expecting that their first year they're going to lose money, or they're just expecting that, okay, starting day one, I'll be just assuming the cash flow that I'm underwriting this instead of taking these precautions, or especially based on current situation that it might be a negative, and just if you can withstand it, great. If not, you need to know that so that you either should or shouldn't do this deal.
Yeah. I mean, and in all types of real estate, in all phases, the periods of time where you are investing into the property that are the higher leverage periods of time, right? You're not having as much cash flow because you're taking units down and you're bringing money to the table. So you not only have less cash flow, but you're also responsible for putting more cash in when you're investing. Those are the riskiest periods, right? So it's one thing to look at a deal and say, oh, when this is stabilized, this looks amazing. You also need to know what's it going to take for me to get there and how long, because I'm super exposed during this period of time. You hear about, new developers go bust all the time when they're doing like ground up development, because that's the riskiest phase of the real estate cycle, is when you're taking something from the ground to vertical, right? You got no cash flow. It's oftentimes personal recourse loans, and you're financing. You got to bring a lot because there's no business there yet. It's just speculation, right? And so they're the ones that go bust first. And so in a period like this, if you're trying to execute a business plan like this, you want to know that you can bring the capital to the table to weather the storm. So if you can, then then that's a competitive advantage. Because at a time like this, capital is getting a little skittish, but you need to know what you're getting into as well.
Ryan, man, this is awesome. I feel like we might need a part 2 or a deeper dive, but I mean, this is as good a review as I think could be done in an hour for someone that's considering, or even just this deal, looking at if it's worth doing or worth not doing. And then you could always play around with the actual asking price or the loan numbers, stuff like that, to see how you can make it a little more attractive. And then you can, what I like about this, I mean, if you analyze any deal with a spreadsheet, you'll be able to do this. But what I like about this is you can go back to them directly and say, all right, here's how it is currently, and here's why I'm making the offer that I'm making, because I'm looking to do this, or this is what I'm expecting in this year. So, and if not, I think it makes a lot more civil instead of people just throwing out lowball offers to feel like they're negotiating. They don't even know why. They just feel like they can't pay list price. But I think this gives someone the ammo to go back to a seller and say, here's why I'm actually offering what I'm offering. And if not, it's okay.
Yeah. The sellers a lot of time they'll see the potential in the property they're selling. Like, so this seller probably knows they could get close to $600 a rent instead of the $433 that they're charging, but for a variety of reasons, they've chosen not to do that. But boy, when it comes time to sell, they're going to act like they're already getting that $600, right? They're acting like this is a fully realized opportunity. And so it's always a challenge to go back to the seller and be like, look, I'm not going to pay you for the risk burden that I'm taking on to execute this business plan, right? So a lot of buyers some will have a really hard line in the sand, and they'll say, look, I only pay for actuals, right? This is a property that is earning an NOI of $52K a year. In your market, an 8 cap is reasonable. And so that puts me at $750K. That's my offer, right? That's a very strict line to take. Some people have success with that. Others will, and I think I'm kind of more in the middle, which is, okay, yes, this is a property with opportunity, so I'm willing to pay a little bit more than just to actuals, but I better be well rewarded for my risk that I'm taking on to actually see this thing through. And so don't expect to get the full price of what it will be, because that's the risk I'm taking.
Yeah. All right, man. This was amazing. Great stuff. Seriously. I think this is like exactly what anyone needs, just to understand, like, even why some of these numbers matter, but then how to make an offer and how to be smarter about making offers. So really good stuff.
Yeah. All right. Well, go put that $450,000 offer in on this thing and see where it gets you.
And then we'll Airbnb them out. So, we'll double the NOI actually.
You got 20 brand new Airbnbs. Perfect. Come to Middletown, Ohio. I'm sure they have like the world's largest rubber band or something that people need to see.
Yeah.
Are we going to get a bunch of Middletown hate, like spam from people in Middletown that we're making fun of their area?
No, they don't know how to use computers. So, no problem. Actually, we could probably just hang on one sec.